if you draw a line, this is something that David Ryan always used to say, in our master trader program, he'd say, just draw a line, man. You want to find out, where the supply is, just draw a line, so I always say that, just draw a line. So if you draw a line across from the top of the pivot, you always want to start at the top of the pivot where it's breaking out from. If you draw that line across, then you look to the left. This is how you determine supply and start to see if supply is going to be a potential issue. Take a look here. As you draw that line, you see it's only traded above that level on 1 week, and it couldn't even close above that level. So now you're tightening up. So tightening up on the right side and volume coming down means that supply has stopped coming to market. This is a concept that I learned from Bill O'Neill many, many years ago when I met him. And it took me years to think about it and let it marinate before I really understood how to use it in my trading. And it was the most valuable thing probably that I ever learned from Bill O'Neill. So coming out here, this is taking out that supply pretty much. Now, yeah, you do have that high on the left side. And I'm always looking, I'm a big stickler for supply. I'm always looking to the left. And that decline too on that week, again, wasn't huge volume. It didn't even have a bad close. It was only 1 week down. You came back pretty quick. So I'm more constructive on this. And also, if you look down, I always pull up a weekly chart and I look at the weekly volume versus the price. If you notice, there's only 1 week in the entire life of the stock that the volume on the downside traded above average. So this has really been just all accumulation. There's really just no distribution whatsoever except that 1 week. And if you're going to have a week down, it would be on the left side. If you wanted to see, where you were going to have your sell off, it should be on the very left side. So now, with all that said, and build this big technical case, this stock now, how do we know if that analysis is indeed holding water? Well, now we see it's game time. The rubber's meeting the road right now. This stock should break out. It should hold and take off from here. Now, if it doesn't and it has trouble, well, then, maybe there is a seller out there. Maybe there is a big seller. We don't know. We don't know for sure, but we're using the chart to get the best guesstimate and to narrow it down to the higher probability situations. I would have liked to seen it tighten up a little bit more. With the volume came in quite nicely, and I would have liked to seen it tighten up a bit more to show me that really last bit of supply really came out of the stock, and you got rid of all those weak hands. But again, it looks pretty constructive. And one last thing, and this is another thing that David and I always talk about. We like to see the IPOs that come out in a correction or a bear market. Later on, when you get in the later stages, they just throw everything at the market because they're buying up. You got to realize this is a business. And when there's buyers, the underwriters go out there and they start putting out IPOs. So the only caveat is that, I don't like these IPOs that come IPO late stage when the market is run up. I'd rather see this coming out, from a correction. It would be just a small little, nuance.
Mm-hmm. Okay, so how would you be sizing your position, Mark, with something like this, and where would you be getting out?
Well, I'm always backing into the risk. So the first thing I do is I look at the chart and I say, okay, where would this sour? So I certainly wouldn't want to see this go outside and engulf the entire pivot area there. So 2605, I definitely want that to hold, particularly today. I mean, if it took that out today, that's that would be a pretty big decline. But now I have to measure. So let's just say we bought this perfect, coming right above the high there at, let's say 29.21. Right. So maybe get a little slippage. We'll call it 29.30. So down there, we go down there. That's about 11%. So see, that's too large for me.
Mm-hmm.
So I can't let it technically stop me out. So then I would have to switch over and I would go to a mathematical stop. Now, how do I arrive at that? Well, now I'm going to go back and I'm going to see I'm going back to that little box I was talking about.
Right.
What have I been pulling out of the market regularly? What is the upside? So now I don't care. I'm not going to speculate and say, well, this stock, I think can go up 20%. That's pie in the sky guesswork. What have I actually been pulling out of the market? Let's just say it's 8%. So I can only count on 8% recently on average, not every trade. So I'm going to probably be looking to set my stop around 4 or 5% on this, or maybe I'll stagger it. I'll set my stop. I'll put a real tight stop at just a couple percent, and that'll allow me to put the other half at, say, maybe 8 or 10%, and I can give it some room on half the trade and real tight on the other half. So there's a number of ways you can do that, but I want to arrive at a number that makes mathematical sense with the amount that I'm pulling on the out of the market on the upside. And then has to also be adjusted for batting average. So let's just say you're getting 10%, right? And you're saying, oh, I could set it at 5%. Well, no, not if you have a 30% batting average. Okay, so now you're not at a 2-to-1 anymore. So you have to adjust it for batting average also.
Mm-hmm. Those are some great points there. And it just so happens that the pattern recognition in MarketSmith has a pink shaded area that shows 5 to 8% below the buy point there. So I was able to easily follow along with you, Mark, when you were talking about those areas.
Mark, when you say batting average, how far back do you go when you're calculating your batting average?
Yeah, well, I mean, I like to look at what, sort of my recent, and you can look at maybe your last, 30, 40 trades. I mean,
Okay.
To be honest with you, I look at my last 4 or 5 trades. I'm always saying, have I made money in my last 4 or 5 trades? And if I get sort of, say I go into the market from cash and my last 4 or 5 trades don't show me a profit, there's no way I'm ratcheting up. I'm probably going to pull back and I'm going to trade smaller until I start. Now, let's say I do that and I get stopped out, and then I go in again and I say, okay, let me try again. I see some more setups and I get another 3, 4, 5 trades that I'm not making money on. Well, then I get even more conservative. 2 sets of them is really, to me, is like the market's not working at all. So I should be able to be making money, in those last 5 or 10 trades. So, but then I'm always looking at my longer term. I'm looking at my long-term bet, and you want to have some statistics there. It's not going to be statistically significant if you're not looking at a good set of numbers. So, you want to look at, your last 100 trades, couple hundred trades. And that's going to give you really where your true average is. Even on the gains, you want to be looking at, what you're gaining on average, say throughout the whole year, and then maybe even your lifetime average. Well, at some point, you're going to get to a point, those numbers might be volatile when you're just starting to do this. You don't really have this down. You don't have a systematic approach. You're not an expert at it. My numbers are very consistent. I can count on them. Even my long-term number is going to be pretty much what is going to happen going forward, just simply because, I've honed this down. So I have a lot of consistency. So you're going to have to, you're going to have to get to the point where, you get you get that number fact set, and you decide, how far back. Maybe you go back 2 years and you realize, well, a year ago I was terrible at this. I was all over the place, and now I'm much better. So you want to try to look at, try to compare it to what you think that you're going to be able to do going forward, if that makes sense.
Yeah, it does. And Mark, a couple of questions from our audience before we move on. One from Steve asking about with your position size, are you buying all at once since you're going for these quicker hits, or how do you scale in or add on to positions?
A good question. Yeah, I'm buying when I can. So if it depends on the size. Like I said, if I have to buy 50,000 shares, I'm not going buying 50,000 shares at the market, even a big cap stock, because I'm not going to go in there and just and take that big position. I'll probably buy 5 or 10,000 shares at a time. But it could be very quickly. I might hit 5,000, see how 5,000, and go very fast into the stock. It really depends. Sometimes if it's a questionable setup, it's, I might go in with a smaller position, and then if it acts a little better, I'll add to it. Sometimes I'm starting at a pivot, like which I call the low cheat. Some of you have followed me know I the signature low cheat and the cheat areas. I might start a position there, and then if it forms another pivot and it holds up well, I add to it and I start pyramiding into it, similar to Bill O'Neill will pyramid into stocks base after base on a longer term basis. I do it on a shorter term basis within the base. So I'm looking for those resets, but to happen within the base, and sort of build my position from the low of the base to the handle, and then get my position on as it's coming out of that base. But you don't always get that. So the real answer is that if the stock is set up right and it's breaking out, I'm taking my whole position right at the buy point. As soon as it hits that buy point, I'm in.
Great. And adding on, not on a percentage gain, but if it sets up again, technically, if you see another level to trade off of.
Yeah, I know that's a popular question of, and I think sometimes it's misunderstood too, of even what Bill O'Neill talks about, is that, I'm not adding, I personally am not adding just because the stock is up, 3 or 4%. As a matter of fact, I'm staying away from it at that point, because now the stock is extended. So I don't want to buy a stock up more than 1 to 2% from the pivot point. I'm never chasing it up more than that. Back in the day, David and I just talked about this just the other day, as a matter of fact, back in the day when, we had much bigger moves from stocks, because you couldn't short-term trade. You didn't have what we have today. It was a whole different landscape. We would buy 5% above the pivot, sometimes even 10. And what we were playing for, minimum move was a double. We were playing for a much bigger move. And then when the internet, this fast trading and commissions came down, and you were able to do shorter term trading, those parameters got compressed.
One more question from Gary before we move on is, are you putting an actual stop in? This is a question that we get all the time too, or are you waiting for a close below where your stop is, or are you doing a little bit of both when you're scaling out?
Oh no, if the second it hits the price, I'm out. There's no vacillating. There's no, I'll wait for it to snap back. This is the real, probably the biggest problem with people using stops, that they don't really use stops. They might use them. Like when I first started trading, I did use stops fairly early in my trading career, but every now and then, I fall in love with something. I'd fall in love with the story, or it would go blowing through my stop. And now instead of taking that 8% loss, I'm down 15 or 16, and I'm all bent out of shape, and I don't want to take that loss. So I say, okay, if it comes back, I'll sell it if I'm down 8%. Next thing you know, I'm down 20%, and I'm down 25, and now I blow myself up. That's how, my early blowups happened, or my big give backs of giving back all my gains, was all because, I vacillated and I didn't have that line in the sand. But now there's a line in the sand. I go into the trade, I know where I'm getting out before I get in. I'm never getting into a trade unless I know where I'm getting out first.
Right. So if you see an upside reversal, do you get back in, or just, it's that part of being consistent, whatever you're doing, whether it's, Justin, maybe he's using a 5-minute chart and looking and seeing how it acts before making that definitive decision. Being consistent with your selling strategy.
Right. But I'm never getting back in just because, it reverses. It's going to have to meet the original criteria all over again. So it's still going to have to meet all the criteria that I look for. And everybody who knows me knows now BCP has become like the vernacular of the world now, from Mark Minervini. That's sort of my signature thing, which, isn't necessarily a pattern. It's a characteristic of a pattern. So I'm always looking for that. If it doesn't still meet that criteria, then I'm not getting in. But I do have a lot of little techniques that, that are reset techniques and reversal techniques that would get me back on a stock that might have just stopped me out. So I definitely don't erase it off my list. Again, I'll go back to David and I, we both keep a list of our stocks we sold. If we just got knocked out of a stock, we don't just like erase it and never look at it again, because it might still meet all the fundamental criteria. It might just be a short-term hiccup. And sometimes the pattern actually gets better. You'll get stopped, and then a couple of weeks down the road, or even sometimes days, it tightens up, and it was a little shakeout within the handle, and it actually looks way better just shortly down the road, and you can re-enter it. But again, only enter if it's meeting the criteria. Don't get emotional, and because it stopped you out, start revenge trading and have to get back on to prove that you can win. And the stock is wrong. Make sure that you're still having a criteria. It doesn't matter what the criteria is. It doesn't have to be my criteria. Whatever your criteria is, have a plan, stick to the plan, evaluate the plan, make your adjustments, but make sure that you're trading from some set of reference points, so you know what to expect, normal and abnormal.
I want to revisit ZipRecruiter. So Mark.
Uh-oh.
Well, yeah, I want to ask you about this. So, what do you think now? A couple of people asking about, what do you think about the squat?
Well, I want to see how it closes. So this is what I call an early day reversal. If you reverse prior to 1 o'clock, I'm not so quick just to punt it right away, unless it starts going outside. And if this comes, like I said, comes down, we start engulfing the pivot and engulfing these previous lows. That's very, very negative. And then again, like I said just earlier, we're going to find out if this supply, if there's a seller there, if this supply is an issue, by how well it breaks out and if it can hold. Now, the theme of this market has been where stocks are not breaking out clean. They're not holding. You're getting tons of squats. It's a squat fest. And if you don't get the squats, if you don't get the squat, they usually, what happens, they reverse in 1 to 3 or 4 days. So this is a very common late stage characteristic of the market, where what happens in the early stages, when you come off of a bear market, institutions are buying. They're buying the market down. Retail doesn't want anything to do with stocks. They're licking their wounds. They've been beat up through the bear market. They didn't cut their losses. They're not convinced. The news is horrible. They're not buying anything. Okay, now fast forward the bull market for 2 years. Now the market's been doing great for 2 years. Tesla's up 1,000%, Apple, Amazon, everybody's made money. They're all convinced now. Now they've seen the breakouts work, one after the next after the next. Now they're in there buying. They're in there buying. And guess what? The institutions are selling. They're selling at the strength. They're unwinding positions that they started a long time ago, these long-term positions that they have big profits in, or even newer positions, maybe that they might have been even buying off the lows. And this is, when these stocks off the lows, you're getting institutions are supporting these, and they might be even, trading out of them, or maybe the prospects of the company have, are not as good now. There's a change, but you don't see it yet. It didn't show up in the fundamentals that are reported. So they're using the strength. They're using the strength for selling. If you take a look at something like Kathy Wood, I say Kathy Wood because you can get her trades. You can actually see her trades. You can go to a website and see her trades. You'll notice that she's almost always buying when stocks are down and selling when stocks are up. So that's why it's so important to see if the stock, how it breaks out and if it holds. And I talk about all this in my second book, Think and Trade Like a Champion, of everything to look for post breakout and on the breakout to determine if that stock is acting normal or abnormal, right? So far, this is abnormal. This isn't the best action, but in this market, this is to be expected. And that's why you have to really, but talking about the early day reversal, I want to try to give this to the end of the day. And here's in real life, here's how it works. You should have already determined your stop loss. There should be no guesswork right now. All right. You bought the stock and you've already decided, I'm going to risk X, whether it's a percentage or a dollar amount, whatever it is, you should have already determined that. So stick with that stop. That should have already made sense. You shouldn't be getting emotional because you have a reversal here. You've already made an unemotional pre-trade decision of where you're going to stop. So if it doesn't hit that, I'm going to try to give this early day reversal to the end of the day. It's going to either my stop, or I'm going to get to the end of the day. Now, at the end of the day, if this closes on its dead low and it has a big, huge reversal that engulfs, the pivot, I'm almost certainly going to reduce it and cut it in half at least, and maybe even sell it. But it depends how ominous it looks here. And right now, if it closed right at the lows here, I would definitely reduce this. Now, see, you're starting to come back here. All right, you're coming back in the range a bit. Let's just say you get a close and it squats in the mid of its range. This might go inside for a number of days. Maybe it takes 2 or 3 days, goes inside. If it can stay inside and not take out that low of today, that would be a good sign. And then if it takes out the high, that would be what I call a reversal recovery. And that would be very bullish. So again, sometimes the stock comes out a little bit early. You get to the later stages of a bull market, and a lot of retail money plows in there prematurely. But there's not a lot of supply. So even though the stock stalls out, and this is why these early day reversals, I give them some time, because it may not be that there's a big seller there. It just may be that the big buyer's not coming in just yet, or the stock, just moved out prematurely. And so I give it a little more time here. So we're still okay with ZIP. I know I segued, but I'm watching it over here.
No, but that's useful because again, it kind of shows what you're doing is you're constantly doing this. Okay, the market does this. Now, now how do I view that? It's constantly looking at that market feedback to make your decisions instead of just like making a snap decision on just one data point. You're using like Upstart 1,400 variables.
Well, Justin, that's correct. And you have to think of it as like you play poker. So you start off with aces, right? It's the best hand. If you're going heads up and you guys are pushing all your chips in, you've got a 80% chance of winning. However, so you have a pair of aces, you start, a few people call, and now a flush falls, and someone starts betting heavy, and you call, and now another heart falls, and there's 4 hearts on the board, and you get a bunch of, and people who know poker would know this, of course, and now you get someone shoves all in on you. Now your aces aren't so valuable. Now you've got to make a decision on that new information. The hand has degraded. Well, but let's just say you flop an ace, your hand improved. So each time, that's why charts are so valuable, because you keep seeing that next card, and you get to see what's happening here, and you adjust. That's the beautiful thing about this. It doesn't have to be an all or nothing bet. You can adjust, you can make changes as the information comes. And the real key to stock trading is instant liquidity. Imagine if you could do this with real estate. You go buy a house, and then you don't like what the market is a couple days later, and you just sell it at the press of a button. It would change the whole real estate market. People would be flipping houses every day, right? So, but that's what you could do here. You could put millions of dollars to work and get out instantaneously, and that's why it's so powerful. That's what the opportunity is that you have that incredible opportunity, but you have total liquidity, and you're able to. And charts are a big part of being able to ascertain and make those decisions and see those cards unfolding and seeing the hand improve or degrade.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.